Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for October 26th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Good morning, guys.
Good morning.
Good morning. How are you, Ken?
So we have the East Coast Nor'easter represented by Dean, who's in Boston, and we have the West Coast Bomb Cyclone represented by Ned. In the Midwest is just dreary. So I hope you guys are staying dry and safe.
Good so far. A lot of flood watches and some rescues going on in New Jersey this morning. So I think the whole I-95 corridor will slow down dramatically today and tomorrow.
Yeah, so if you're out there moving freight, again, all joking aside, please be safe. I saw pictures out on the West Coast of a extra lease trailer getting completely blown almost off a bridge. Thankfully, the girders were there to stop it from going all the way, but it was kind of crazy. Before we get started, another little bit of small talk, given that it is spooky time. I'm curious what you both are going for as Halloween this year.
I'm going as Bowser. My son decided he wanted to go as Mario, and so it'll be nice to be able to do trick-or-treating again this year.
And because there's a shortage of Halloween inventory on the shelves, I'm going to bring out last year's costume, which is Crocodile Dundee.
It works every time. I have to admit. Now this is a knife.
No. My version is that it's just a triple. 328-foot trailers doesn't make a triple. You've got to throw 353s together.
That's funny. I'm going as the most valuable commodity in America this year, which is a unused shipping container. My wife didn't get the joke. It kind of fell flat, so I'll probably just end up being a giant banana or something again. I don't know. One of my three costumes. So for those new to the show, we go through freight here every week, talk about trends in the market, but most importantly, answer your questions. So please get them in early in the comment section below or in the chat. We have folks that forward them over to us so we can read them at the end. And it would be great to get a bunch of questions this week. So with that, I'm going to go to our key points of the week to get us rolling. So a lot going on. Obviously, I mentioned the weather earlier in the show. We are seeing spot rates come down a little bit. Again, this isn't like a monumental pullback. We're talking about a few pennies a mile here. Contract rates came down a little bit as well. ATA tonnage down 2.4%, up 2.4% in September. That was the largest sequential gain in 21. U.S. Bank Freight Index, another kind of interesting thing to watch. Q3 21 shipments were up 1.5% quarter over quarter. Again, probably the most heavily watched statistic in freight right now. We got 77 container ships at anchor off in Southern California, which is a little over 500,000 TEUs. Again, an executive order that declaring 24/7 port operations does not 24/7 port operations make. Dean can get into more of that, or if you have questions, drop those below. And again, capacity is just not coming into the market fast enough to stave off the rate in capacity tightness. So with that, I'll turn it over to Dean to walk us through the update. Dean?
Yeah, thanks, Ken. Let's start off with the load board activity in dry van last week. Volumes were down for the third week in a row, down 8% week over week, now down 15% month over month. Equipment posts decreased slightly also, so the load to truck ratio moved down again this week to 5.14. In the refrigerated category, load posts dropped by 12% last week, still up 37% year over year. But now down 18% in the last month following 4 weeks of decreasing volumes. Equipment post decreased also. That pushed the load to truck ratio for reefer down from 11.69 to 10.76 last week. And in flatbed, following an unseasonal surge in flatbed load board activity in September, load post volumes dropped for the second week in a row last week, down 9% week over week. Equipment posts were mostly unchanged last week, though, so the net effect was a small decrease to 42.62 for the flatbed load-to-truck ratio. So having a look at our market condition index, lots of activity across the country. As Ken mentioned, freight congestion on the West Coast. If you look at a lot of the social media posts and some of the folks that have been touring around and hiring boats, you can see there's very little activity. It almost looks like congestion has ground the port activity to a standstill. Space is clearly a big result or big cause of the activity there. Capacity in the overall Los Angeles market remains tight. There's no change in average outbound spot rates last week. They stayed at $3.32 a mile, but on high volume lanes, including Stockton, Phoenix, and Chicago, average line haul spot rates set new 12-month highs last week. So still upward pressure on rates that for a lot of those warehouse markets. Los Angeles to Stockton, 419. East to Phoenix, average 448, excluding fuel. Loads to Chicago broke the $3 a mile barrier last week, now at 308, excluding fuel. On the Chicago, southbound from Seattle to Stockton is also another one we're watching. There's a lot more inbound import volume going into the Pacific Northwest. Seattle Stockton, $1.52 a mile last week. That's up 14 cents over September. Seattle to Chicago is another intermodal lane where some volume's trickling over to truckload. Chicago rates hit 236 a mile last week. That's up 75 cents a mile year over year. Having looked at the market condition index for refrigerated, of course, Los Angeles to Las Vegas, still over $6 a mile, averaging 606, excluding fuel last week. Capacity is continuing to tighten in the Pacific Northwest as we see each time of the this year. Apple and pear harvest is ramping up. Washington State and Oregon produce around 85% of apples and pears this time of the year. Truckload volumes run at about 3,100 truckloads a week in November. They'll peak in January at about 4,000 loads. In the Pendleton market, reefer spot rates were up 10 cents a mile last week to an average of 298. Load post volumes were up 24% month over month. And in the last seven days, Pendleton to Stockton hit a new 12-month high of 264. Pendleton to Los Angeles recorded a 12-month high of 258. And just overall in the produce market, the USDA reported a shortage of trucks in 50% of the 20 produce markets being tracked each week. That includes carrots, grapes in Kern County, California, even lettuce in Salinas to apples in New York. Shortage of trucks in most of those regional produce markets. Having a look at the flatbed market, last week's US Census Bureau housing starts and new permits generally missed market expectations last week. The flatbed freight intensive single family home sector was flat sequentially, but and still down 6.5% year over year. So definitely some slowing in the single family home market. The September numbers are interesting in that they mark the first time since the pandemic that monthly home starts have decreased. In Ohio, capacity tightened last week on the 430-mile run from Cleveland to Roanoke, Virginia. They broke through the $4 a mile mark, up 53 cents a mile in the last month. And in nearby Pittsburgh, capacity was also tight last week, up 14 cents a mile to 366. So wrapping up now with our year-over-year view, look of spot rates. In the dry van sector, 2 weeks of declining spot rates, of course, doesn't make a trend. But considering both dry van contract and spot rates decreased last week, we are seeing a little bit of that seasonal cooling in rates we'd normally expect to see in October. We'll keep an eye on that one next week for sure. Spot rates were down 3 cents a mile, largest decrease since June, ended the week at 249. Dry van rates are still 30 cents a mile higher than this time last year. And in the refrigerated sector, after 3 weeks of increasing rates, last week's decrease of 4 cents a mile erased all of the October gains, ended the week at 284, excluding fuel, still 48 cents a mile higher than this time last year. And lastly, in flatbed capacity continues to ease. Spot rates dropped another 4 cents a mile, averaging 259, excluding fuel last week, up 36 cents a mile compared to this time last year and 42 cents a mile higher than 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly market update. Over to you, Ned, for the short-term forecast.
All right, so we're going to be starting off with dry van short-term forecast. So for those of you who have been following week over week, we had to cut a couple of weeks off the x-axis so that the trends would be more obvious. So again, the line might be missing some of the historicals, but we still have them. And if you have a burning desire to see very long-term trajectories along with the short-term forecast, we can provide that. Anyway, going into detail. We're beginning with dry van. On the blue, you can see the market rate observed by DAT. And then off to the right, you can see our different forecasts. In green, you can see Ratecast is expecting slow and steady upward pressure to be present on the dry van market, going up about 5 cents, it looks like, over the course of the next 5 weeks. In the short-term forecast, in red, you can see that it's expecting a little bit more of the opposite, that the cooling trend that we've been seeing will continue, and the rates will drop by, again, about 5 cents over the next 35 days. Finally, in gold and silver, we have our two blended forecasts, which are mixtures of those two forecasts in different amounts and in different ways. And you can see that overall, they kind of straddle the middle, maybe leaning a little bit more towards the short-term model, dropping maybe by about 2 cents over the course of the next 35 days. So it's kind of a choose your own adventure. There's seasonal pressure upward, but the short-term trends are definitely pointing down. Next, into the reefer. Here we have a very strong model divergence. Once more in blue, you can see the market rates observed by DAT. Then off to the right, you can see that there's model agreement for the next 2-ish weeks, and then there's a big divergence where Ratecast is expecting the Thanksgiving turkey and other Thanksgiving assorted goods to really be picking up and shifting things up by looks to be about 10 cents when we hit that period. Short term doesn't really understand Thanksgiving as well, and so it's expecting things to continue more or less steady as she goes, maybe a gain of 1 cent over this period. And then the blended forecasts in gold and silver are expecting a little bit of a gain over that period, but not quite as much. I'd lean mostly towards the Ratecast model here, assuming that Thanksgiving is anywhere near normal. This is the kind of seasonal pattern that Ratecast is really good at picking up, and I don't expect there to be much of a ability to kind of shift the loads around for that period. Finally, moving into flatbed, here you can see in blue the market rates observed by DAT, and then once more there is model divergence, although there's overall agreement that the trajectory is down. Ratecast in green is expecting rates to drop a little bit and then stabilize at about the same level. The short-term model is pretty pessimistic, expecting a drop of about 20 cents over the next 35 days. I think that's a little over pessimistic, but there's definitely a downward trajectory in the flatbed market, so do be aware of that. And then the blended forecasts in gold and silver are leaning more towards short-term here, although they're breaking a little bit at the 3-week mark. And that is it for forecasts. Please get your questions in. We've gotten a number that are good, but first we're going to handle our IQ question of the week, which is, can you go into a deep dive on the freight dynamics of the U.S. South Central market? So I think it's important to start off by defining our terms. What is the U.S. South Central market? Wow, bam. All right, so you'll see here this beautiful chart. So DAT has a bunch of regions that are defined. So South Central is centered mostly around Texas. So it's that Texas, Oklahoma, Arkansas, Louisiana, that zone. And then you can make arguments for it maybe being part of Mississippi and Georgia. But different from the Southwest market off to the left, New Mexico, Arizona, etc. And it's also different. It doesn't include the Florida, South Georgia market, which is its own kind of thing. Any more context that you guys want to provide around this?
I've got some fun facts if you'd want me to sort of kick things off, Ned.
That's probably a good
by all
idea.
means.
Yeah, I had a look at some data this morning. Texas, Dallas and Houston are our number 1 and number 2 flatbed markets. Houston's at number 3 for load posts in dry van. Dallas is number 8 this week in dry van and number 8 in reefer. So they're always in the top 10, often the top 5 markets in those Texas markets. They're some of the largest in the country. If you look at Dallas, Dallas is a huge market. You've got 50 million people that live within a day's drive by truck. You've got a lot of volume comes across the border, the southern border through Texas. Laredo is one of the biggest ports for truck crossings. It's an easy 1,200-mile run to Atlanta and Phoenix in either direction. So it's an easy 2-day drive by truck from either of those markets. About 72% of truckload moves cross in Texas from the import perspective, about half of those in Laredo, and about 92% of all rail moves cross through Texas. So both those sort of deep south Texas border markets have a lot of truckload and rail volume. Of course, it's a big produce crossing market as well. 47% of total truckloads last week were imported. 90% came across the southern border, 10% in Mexico. About 50% of the volume also comes through Texas, and about a third of that comes through the McAllen market. Just generally at a high level, Mexico is our number 2 country for imports, slightly ahead of Canada and behind China. On the export front, it's also our number 2 trading partner for imports behind Canada. So that's sort of the high level information. there's a lot more to it. Over to you guys.
I mean,
Yeah, I think it's a good question, and it's honestly sparked in our internal discussions that we might take maybe a region or so every month and do a deep dive on the show if that's something folks would find interesting. I mean, I think some are more interesting than others, right? I think we define, if we're still looking at this map, right, we define California as its own region. I think you could probably make a case genuinely that you could probably split California in the northern and southern. They're two very, very, very different freight areas. The Pacific Northwest coming up will be something very closely watched, if not already, for Christmas trees and things like that. Apples have already passed, right, Dean? I mean, the peak of apple shipping.
Correct.
Coming out of the Northwest. But yeah, I think if you have any additional questions about South Central market, Texas specifically, please drop them below. That was actually a user or a listener submitted question a couple weeks ago, so I'm glad we were able to take a closer look at it. We seem to have maybe lost Ned. Is that the case?
No,
you guys
I'm
still
here.
see Ned?
I'm here.
Oh, you froze a minute ago. The other thing, Ken, with Houston, it's one of our biggest flatbed markets, and we see a lot of activity out of Houston in the energy market, not just bulk liquid, of course, being such a big oil-producing state, but also a lot of the drilling activity that goes on out in the Permian Basin. We see an incredible volume of flatbed drill pipe that are running out to the Permian. So it's
especially with oil prices where they are, right?
Right.
Yeah.
Right. Drilling rates are increasing.
Yep. For sure.
Something that from a
cool. All right, we have a ton of questions backed up here, so again, if you have any, please feel free to drop them in, and we'll do our best to get to as many as possible. So, in Ned's absence, I'll read them, and I apologize for everyone watching me squint. Christopher Davis, how can we get the cargo vans running when there is so much freight? Dean?
Sorry, I missed the question. Where is it?
How can we get the cargo vans running when there is so much freight?
Cargo van. We're talking about sprinter vans or box vans?
Yeah, I mean, so when I was in the industry, the difference between a cargo van and a sprinter van was one pallet, or maybe some of them had like a lift, right, to get them up to dock height, some of the sprinter vans.
Okay, I'm not following the question. How can we get cargo vans moving when there's so much freight?
I'm supposing that the question is basically they're not as busy as they would like, given that how busy we are for 53 footers. I can take a stab at it. So when I was in the expedite side of the industry, obviously cargo vans were a huge part of that, right? Shuttling. It started as shuttling parts supporting the big three automakers in the Midwest. I'd say right now, that's probably where you're seeing those industries slow, right? So in the start of the pandemic, when I was reaching out to a lot of the folks I knew in the expedite industry, they were seeing a compression in cargo van volumes. Honestly, again, I think there are ways you can leverage the DAT board. There are other smaller equipment-specific boards out there that you can go to. But again, I think reaching out to a broker or reaching out directly to shippers looking for that small freight, and then maybe even taking the angle, if you're a carrier, saying, look, I know truckload capacity is so hard to find right now. If you just want to move a couple of the pallets to get your things moving, I'm more than happy to do that for you. Yeah. Again, I don't have a great handle. I mean, those rates kind of seem to bounce between anywhere from 95 cents to $1.25, $1.35 a mile for cargo van when I was in the industry. Again, I wouldn't be able to really speak to where those are now. We don't have a ton of visibility. It does seem like I was in Denver last week, so I missed the show. We were having a big planning session for next year. Every week we get at least 1 to 2 cargo van / box truck questions. So I am escalating that up internally through our product orgs to see if there's not something we can do to help at least provide some insight into that market. Welcome back, Ned.
Good to be back. I didn't think that I left, but apparently there was some weird connection. I could see you guys fine, and so the fact that you couldn't see me, it was wild. Anyway, are we on to Santi Renton's question?
Yes.
Santi Renton asks, in terms of drayage, from the perspective of all you guys' expertise, what do you guys think is the solution for the container crisis? What is the best way to solve these port backlogs? I mean, that's
yeah, look, I think it's a space issue. If you look at all the social media posts on the weekend, and I've been talking to drivers for the last couple of weekends, just understanding what the issues are. It's clearly a space issue. There's certainly plenty of trucks, plenty of chassis trailers it's clearly a space issue when you think about the inability of multiple ship-to-shore cranes to work per vessel. They're down to one, maybe two, because there's a physical limitation on how many spots they've got available to drop the loaded container, which then flows on to the inability to bring back empties. So I think it's a space issue. That's why the executive order is looking at nearby land to try and open up more space. I think it's a physical space issue, but there's some things that are broken in our supply chain, and that's one of them, is the lack of space when we put too much volume into a supply chain that worked very efficiently for many, many years. We just overwhelmed it in the last probably 9 months.
Well, I think too, right? Even going back a few steps, the way that I equated this to a couple customers earlier or later last week was it's like having a massive shortage at a restaurant and being unable to handle your volumes, and your answer to that is just to keeping the dining room open longer. Right, you still need cooks, you need servers, you need to get more product in, you need more people working the reception stand. I mean, so it's sure keeping the gate open 24/7 to start. It enables all the downstream stuff, but you still need crane operators, longshoremen, tow truck drivers, dolly drivers. You need chassis, you need containers, you need space. I mean, all of these things, the on-port warehousing and cross-docking. I mean, all that stuff has to function to increase throughput in a meaningful way. Right.
Yeah. And to your restaurant analogy, I think that it's important that a lot of once you've got this amount of volume, it's really hard to ungoof it right now. Once you've got people coming out the door, the time to do it is during the slow periods to look and see where there are inefficiencies and where you can kind of streamline your processes rather than trying to do some crazy stunt to push everything through.
Yeah, I mean, I'll cut the ports a little bit of slack, a little more than perhaps normal. I mean, it's a once every 100-year, thankful, hopeful event. So I don't know. I mean, they've been sort of in the thick of it for the last 18 months. Mm-hmm. So, I mean, we were just chatting before the show, right? Last year, the big story was a few containers falling overboard and 20 or 30 ships being backed up in Southern California. Right? It's not even on the same playing field as where we are today.
And more coming in the next 2 weeks.
Yeah.
So to that, Santi asks again, do you guys expect the yearly rate per mile increase? Sorry, my thing scrolled. And overall spot market rate increase to match with previous years given the container crisis happening right now? I mean, from a modeling perspective, my expectation is that some things are not movable. Thanksgiving is not movable. There's going to be the increased demand for reefer stuff around Thanksgiving, and that's the next kind of big lump of typical rate increases. But there might be.
Yeah, I think. Or again, another pre-show conversation was wagers. One wager I'd be ultra comfortable with is spot rates will be down year over year next year, and contract rates will be up. Now, I think the way that we measure that is going to be important. We see things are moving a lot faster, so we could see contract rates peak and start to crest sometime late next year. So I'm not exactly sure, chronologically, where we'll end the year. But my full expectation, and I'm rather confident in this, is that sometime in 22, spot rates will round the corner and start to decline, and we'll start to see year-over-year negative comps by, I think it's a little hard to predict specifically, but I would guess sometime in no later than the second half of the year.
Okay.
Thoughts?
I mean, that seemed like a safe bet last year, and then it didn't. So I'm a little gun shy about that. But I think I would, given what we've seen, I would take the over. If you set the line at you said Q2, so if you set the line at let's call it May 15th, I would take the over on May 15th.
For year-over-year negative?
Yeah.
Oh man, I mean
I know that's wild, but I mean,
we'll have to put some more thought into that and maybe bake it into an official wager.
I'd be happy to.
What do you think, Dean?
I'm with you on this one, Ken. I don't. I think that's Q2 is going to be when we'll see some settling down in the market.
I mean, we could theoretically. I mean, not theoretically. I think there's. Hold on. Let me just before I open my big fat mouth. Yeah, I mean, I could very easily see us being year over year. Well, okay, so it's going to be interesting, right? Not to spend too much time on this, but we had the pre-polar vortex there's a huge dip,
Yeah.
right? If you remember from our slide, the red line. I mean, there was a big dip there, so that could buoy year-over-year comps. I mean, it's all just funny math at that point, right?
Yeah.
So I think we're probably not going to be having some serious risk of lapping it until April. We'll see.
We'll see.
No, right.
Nawab asks, what's the rate for reefer from PA to Texas? I don't think we have that on hand, but if you will email askiq@dat.com, I think that we can get you some information there.
Or if you drop in the comments in the next 4 to 5 minutes where in Pennsylvania to where in Texas, I can actually run a rate for you here in the background. So, I mean, PA is just, it's too general, right? Philly's not the same as Pittsburgh, and Houston's not the same as Dallas, is not the same as El Paso. So if you're at least specific to the city, zips being even better, I'll do you a solid and run a rate view rate while we're sitting here.
Yeah. I mean, just quickly, rates are going down, Dallas to Pittsburgh, but going up in the opposite direction. So it just be some rebalancing to reflect the freight flow imbalance.
Stephen Litton asks, spot actual for reefer last week was 288, but according to your actuals on the forecast, it never got above 285. Why the discrepancy? The answer has to do with the way that we report the numbers. So with the forecast, we report a combination of very long haul trips and semi-long haul trips. Dean, totally correct me if I'm overstating. Whereas for the actuals, we report just the very longest haul trips. Is that correct, Dean?
Correct. Yep.
So
I thought it was the other way around.
Is it the other?
It would only make sense the other way around because with the forecast being cheaper, you're stripping out that 250 to 550 band.
Yeah.
It's just the other way around. We only report 550 plus for the forecast, and we're reporting 250 plus for actuals, right. And that's just to remove friction, right? We're honestly thinking about changing the forecast to percent change so that we don't get hung up on this. Because I agree, there should be one source of the truth. So we're toying with the idea of in 22 shifting ratecast to a percent change, which is how most people represent forecasting anyway. I'm not a big fan of index pegging, so like pegging it to 100, 2012 equals 100, like something like that. I think that's getting too far away from freight at that point. But again, chime in if you have a strong feeling on that.
Matt Clark asks, I've read that there has been a significant number of applications for new motor carrier authorities in the last year, probably from owner-operators and small carriers. Do these new carriers add capacity to the market, or are these merely a shift of capacity from larger carriers to owner-operators? I know Cynthia's been doing a lot of work on this. I wish that we had her to answer that.
I've got some data, Ned, from the latest government data from the census file.
FMCSA?
Yep.
The census file. Okay, yeah.
Yep. Year over year, we've added about 75,000 owner-operators to the market, or new DAT authorities for one-truck operators. That represents about a 28% year-over-year increase. What I will say is that we added most of those certainly in the last 9 months, but the rate of increase is slowing. For the last 3 months, the month-over-month comparison has been decreasing. So we're adding more trucks, but at a decreasing rate in that category. They, just generally speaking, about 74% of all capacity added in the last year has been in that 1 to 40 category. So a lot of small fleets have joined. I think the question is sort of getting to this capacity shift that we've been talking about, or capacity migration, as I called it. It's hard to know how many carriers actually, net new carriers, have joined the industry. I think it's illogical to say that we haven't added net new capacity. Otherwise, who's buying all of these used trucks? Because used truck prices have doubled in the last 12 months. But there has been some capacity migration from leased-on owner-operators to independent contractors. Them have taken their power, their truck, and bought a trailer. I know quite a few guys have moved from the leased-on category to the independent category, running their own authority. The reason they've been able to do that is pretty simple. Average rate's about $1.54 to be leased on to a large fleet. Right now, you're running spot rates in dry van at over $2.50. So the gap between what the rate would be to be leased on and what you're getting in the spot market today as an average is about $1 a mile. It's been like that since September last year. That's going to keep bringing more carriers into the industry, noting that the last 3 months we've seen that slow down.
But with increasing diesel prices, do you think that there's going to be a slowdown in the growth of that small carrier segment?
Yeah, absolutely, because it'll start to hurt them financially. That cash flow crunch is coming. I talked to a number of guys on the weekend. They're not getting the full fuel surcharge passed through in their all-in rate. Those that are working in the spot market, that will eventually catch up with them at some point, given that spot diesel prices are up. I think it was, excluding this week, 26 cents in the 3 weeks prior per gallon.
Yeah, we still have. So maybe we had $1.25 to $1.10 to go before to close that gap, and now we're talking about 75 to $1. So I mean, it's still, it just raises the floor, I think, a bit, right? So it's definitely something to keep an eye on. It takes away some of that buffer.
Right.
All right, let's move through some of these questions.
All right, the crossover says, "Hey, I'm a new dispatcher, new to the industry. What are some things you suggest to research and be valuable so that I'm adding value and not just taking that sweet, sweet cash?"
I feel
Dan?
show your drivers a lot of love. Make sure you know your driver's name. Build a very good personal relationship with them. They're going to be the people that move all the freight and make you look good. So spend a lot of time getting to know each of your drivers on your board.
Yeah, and I would just advocate as well on the flip side of that, know your shippers, or however you think about it, know your customers, right? So if you know that this particular consignee or dock has long wait times or things like that, have your driver prepared. Make sure that you're mindful of detention and time, right? It's not just miles, it's hours, right? It's the key unit of measure here. Right. So put yourself in the mind of the driver, not just from like the experience, but from the business perspective. And I think that will serve you well as you're helping them navigate what's happening out there at the moment.
And never sugarcoat the bitter pill. Always tell the driver. Drivers cannot stand surprises. Make sure you let them know exactly what's going on, even if there's bad news. Always be very upfront with all of your drivers and shippers.
Yep.
John Pandal asks, pardon, the ports of Los Angeles, Long Beach have several databases and dashboards, not just of ships in harbor, but also activity on land. We have gridlock. Any AI approaches to figuring out where to start unclogging this drain? I feel like this is not a good problem for AI. I mean, like, there are a lot of clever people out there, and I'm sure that somebody might have some ML AI approach to handling this. But this is the sort of thing that, like, you really need human brains and OR to do. Like, AIs are really good at exploring a parameter space and finding like unconventional combinations of existing circumstances, or like essentially taking counterfactuals and trying to strip out exactly what's going on. But when you're dealing with like a situation where something like this hasn't happened before and you need like genuinely new approaches, like this is, in my opinion, where human beings with, especially with experience, do really well.
Yeah, I mean, so it has happened before, right? I mean,
right.
The two of the most cringy, dangerous words in transportation prior to COVID were port strike. I remember the last big one in LA Long Beach. I mean, it caused tremendous disruption all along that corridor. So, and this isn't a statement on unions. I think you have the interesting wrinkle on the over the road side of the Teamsters. You have the interesting wrinkle on the port specific side of the longshoremen. You have the high degree of irrationality among human beings that make all AI problems difficult. I think there's a lot of policy. I think there's a lot of labor resolution that could come into place that I hope opens some of the books on that. Those are topics that are difficult to broach and take decades at times to make progress. But I mean, maybe now's the catalyst to figure out how to move past some of these really antiquated ways we think about port operations. I would encourage anyone, I don't know of any good particular documentaries to watch. I don't know that you're able to just drive down to Oakland or Long Beach and kind of take a stroll through the port, but it is still a very, for all the interesting things they have going on, all the modern things around cranes and some of the automated shuttles and stuff that they have going on, it's still a very, very labor intensive, very institutional knowledge-based set of activities that happen.
Yeah, no, I was sitting at a port when I was working for Homeland, and there's an awful lot that's just like people and muscle and just human organization.
Yeah, I mean, a lot of that's by design or by policy, right? there's limitations on what can be done, what
Yeah.
can be automated based on some of these union agreements that need to at least be thought about and revisited. And it's not just the union, right? It's just general labor stuff. California, again, I hope this isn't news to anyone, tends to be a little interesting when it comes to general labor regulation and policy and legislative action. So again, it's all exposure, right? It's all, anytime you have so much stuff happening in one concentrated area, you're exposed to risk. And we're seeing that now. This is risk manifest into actual problems.
Do we have time for one or two more questions?
Take a couple more, yeah, quickly. Lightning
All right.
round.
Baylor Ammon, what would you guys say about the future of the ports and the movement of containers and the potential exemptions being offered for shipping container hauling?
I'll have a crack at that one. I mean, our supply chain system has been built not quite the head of Georgia ports. We can run about 2 million TEU a month through our supply chain in the US and have it work pretty well seamlessly. We've been above 2 million TEU for 9 months now, peaking at 2.6 million. So once we start to get our total volume back down around the 2 million mark, a lot of these problems start to ease. Of course, we've got that backlog we've got to clear. Now, that's on the assumption that we over time start to purchase less and less on the import front and do more nearshoring, which is certainly an emerging trend that we're seeing. So I think there needs to be some exemptions, certainly different roads. One of the executive orders that Governor Newsom talked about last week was changing roads that can handle more truck traffic that are currently restricted, opening up more roads. I think that's a great idea. Right now, you've got container trucks banked up in residential streets, causing all sorts of concerns from residents. So I think the more they can do, the challenge you've got with ports is, of course, they're all landlocked. They're, as in, they're a very small, tiny footprint of land on coastal, ports.
Yeah,
very
by definition.
Yeah, it's hard to get trucks in and out.
Yeah, they can only come in from one side, technically, unless it's like Hawaii, I guess, where the whole thing's a port, technically. All right, moving on.
Kim Posvic, I've read varying opinions on what diesel prices will do in 22. What are your predictions for next year?
Wow. Anyone have a coin?
I do not forecast diesel prices. Gas, it's tough.
Yeah. The government does, and they're very bad at it. So I wouldn't take what they produce with any sort of credence. I mean, there's so much geopolitical. I mean, anytime you're talk about a multivariate problem, right? Geopolitical concerns, production, how much are people going to be traveling? What is the demand for this kind of stuff? I think anyone's guess is, what does inflation do? So I wouldn't. I would punt on that. If you're doing any sort of financial forecasting for 22, I would punt. Would be my guess. By that, I mean just flatline it out based on some assumption on where it is today.
I might just make sure that you've got an ability to function if there's a pretty big swing. Like I would definitely be on the team cushion and have a lot of slack in your system and not be.
Yeah, let me be more specific because we have a kind of a trifurcated audience, right? So if I'm a carrier, I'm assuming diesel's going to come down a little bit to pad myself. If I'm a shipper or a broker, I'm assuming fuel's going to stay high, and so I can make a little room in my budget, just to be clear on what we're talking about there.
Yes.
Right.
Last question. Ashley Schrader, why are SSL moving empty containers to California? They don't have room for more containers.
That's where all the big ships are that take the empties back. We're sending back 2 out of every 3 empty at the moment, so it's a capacity issue.
Yeah, what are you going to do with them? Put them in Reno? Yeah. I mean, yeah, so it's like they need the containers, though, right? Even if they have the room, they would definitely need the containers. And it's just like, again, this is such a bigger problem than you can fit into a 30-second spot on Fox News or CNBC, right? It just is. People spend their whole careers studying this stuff, just certain small sections of it. So it is a very, very complicated problem. And there's no one silver bullet to answering. I mean, really, no, that's not true. The silver bullet is either demand evaporates or all of a sudden we're flooded with a bunch of capacity or some amalgamation of both.
But I mean, capacity, I think what we've been talking to is imagine you could wave a magic wand and double the amount of truckload capacity. That's not going to necessarily move stuff faster through the ports.
No, I mean, in this case, you have to snap your fingers and open up 10 new terminals on land that doesn't exist in Southern California.
Yeah.
I mean, Ashley's getting to a really good point, though. There's all these empty containers heading there. It's just going to make it worse if they don't find more land, opening up really, really quickly. It's actually could compound the problem.
Just stack them higher and hope the wind doesn't blow hard.
Yeah. We can go 9 high, maybe 10.
I just want to one quick thing. Although a 30-second spot isn't going to explain all of it, I would recommend our own Chris Kaplis had a 30-second spot on Fox not very long ago and on Bloomberg. And I would.
It was longer than that. Yeah.
Was
I
it?
think yeah, almost 5 minutes.
I would recommend watching that because he's a really smart guy who really knows the industry and knows his OR stuff very, very well. And so if you want like a digestible version from people who aren't like us, I would recommend it.
Yeah, it was kind of my little tease, if you will, to kind of segue into. If you want to get away from like the talking heads who don't know the industry, Chris was on, I think, Fox Business and Bloomberg. And they were nice. I mean, I don't know how they catalog those online, but I'm sure they're linked somewhere on our website if they're available online. Just a really good perspective, I think, kind of a rational, non-inflammatory perspective on what's happening. Jason Miller had a really good piece that he put out, I think, yesterday or the day before about why this isn't supply chain Mageddon, because like panicking doesn't do anyone any good, right? Is I guess the overarching thing. So with that, I really thank everyone for all the questions. This was as many as I can remember. So this is really great. We will definitely save more and more time each week for questions if we continue to get this volume, because that's really what we're here for. So we appreciate that. Am I missing any plugs, guys?
Yeah, I'll be on Freight Find. Yep.
Oh yeah, Dean was on Freight Find. We had a power duo there.
Yeah. And I'll be on Sirius XM on Thursday at 8 a.m. on Road Dog Channel 146 with Jimmy Mack.
That'll be fun. Always good to listen to. Do they record those for later listening, correct?
I'm not sure. I'll have to ask Ken.
I think they have, because that's when I listen to them. But we'll have to figure out how to link folks over to those. It's good. It's just you can talk about a lot more over a longer period of time, right? Because I think you're on for a half an hour and sometimes an hour, right?
It usually runs 45 minutes on average, because we just talk about a whole bunch of stuff that's affecting the freight industry. There's a lot of truckers listening to it from the cab of their truck, so it's fairly carrier centric.
Yeah, cool. Awesome. Well, thanks everyone. I hope you have a safe and fun Halloween out there. I know this will be the first time in a couple of years people can get out and maybe go door to door. Just bring some Purell. You're already wearing a mask, so it's a good time to get out. But with that, we'll talk to you next week. And again, have a great week, and thanks for listening. Bye.
Thank you.
Bye.